welcome out to Market Master Session 2. Great to be here with you again. Corey Halliday on October 13th, 2015. And today's focus is going to be on primary indicators, where we're really going to look at price action and volume. As we always say, price action is the absolute truth. It is supply and demand in its purest form. So we always want to have a special focus on price action. This course is absolutely critical, I think, to understanding the markets, figuring out solid risk management, where an asset is likely to trade, how to manage that, how to control risks, and so forth. And you'll notice that there's a natural progression through these courses. One leads right into the other. So this week it's primary indicators. Next week it's secondary indicators. Down the road we get into bull pullbacks, then bear rallies, then breakouts. And so it all kind of is a stair-stepping approach. We want you to build a solid foundation and then build upon that. So let's dive right in. As always, we like to remind you that everything we present is educational and instructive and not to be construed as personal investment advice. So last week we went through the Maverick Way. We went through, and we'll do a little short snippet of the Maverick Way in each of these sessions. But we called session 1 the Maverick Way because it's really a focus on how we're different, how we look at the markets differently, and why we think that's critically important. I have a belief that I will believe to my dying day, which is that we're wired as individuals to make bad decisions at key turning points in markets. And if you think about it, it makes sense because at bull market highs, everybody is bullish. That ultimately is what creates a top. If you look at supply and demand, prices will go up as long as there's enough demand for it. What creates a top is when all of the willing buyers have already bought. So if you think about it logically, of course everyone's bullish at the tops. That's how you get that buying pressure exhausted. That's why there's no willing buyers. The incremental buyers have already bought, and thus you have no direction to go but down. And the same thing that happens in a downward market. Once the selling pressure becomes exhausted, once the final willing sellers have thrown in the towel, there's nothing you can do but reverse from there. So Maverick likes to take a different approach to the markets than most, in that we believe that your emotions will get you into trouble. We absolutely firmly are convinced of it, that you will make the wrong decisions at the most critical times because emotionally it's going to feel terrible, absolutely horrible, at the lows, and it's going to feel great, and you're going to feel greed and this euphoria at the highs. Trading systems, the Maverick Way, will protect you from yourself. I can't emphasize how important that is, that we actually really put emotions on the side and focus our attention and really worry more about systems and solid risk management. If we spend our time there, we'll have better results. So the agenda today, we're going to go through the Maverick Way for session 2, then we'll get into candlesticks, support and resistance, pivot points within candlesticks, and then conclude for today. First, the Maverick Way. We think that profitability comes from entering high percentage trades. In other words, figuring out a system where you feel like you have an edge. I've shared one of my systems with all of you. You have in your supplemental videos the Bollinger Band system. It works for me. I feel like it gives me a higher probability trade. In addition, it creates solid risk management. We stop out here, we target here, we maximize gains, we limit losers. That's what trading is in a nutshell. No single trade is meaningful unless you screw it up. Every trade should be like every other. You have in your supplemental videos the Bollinger Band system. You know, it works for me. I feel like it gives me a higher probability trade. In addition, it creates solid risk management. We stop out here, we target here, we maximize gains, we limit losers. You know, that's what trading is in a nutshell. No single trade is meaningful unless you screw it up. Every trade should be like every other one. And if you think about it, you know, you believe in all trades you take. If you didn't, you'd never get into them. The point is that some of them are just going to be bad trades. So move on. You know, if you've ever been in a disagreement with a significant other or a friend or family member, it's much better to admit that you're wrong than to try to dig in your heels and you start to realize that you're wrong, but then you really try to dig in because, you know, you feel like you're going to look like an idiot if you admit that you were wrong. It's just better to admit to it early, say, you know what, I was wrong, and move on. Find a better path, and trading, critically important. Here are the statistics behind it. We broke this down last week that within trading, you're going to have most of your trades fall within this one standard deviation area. Now, based on the numbers, 68% probability that you're within one standard deviation, these are your normal performers, meaning that you have a mild upside move, a mild downside move, you know, nothing overly significant, right? Most of your trades, a bit of profit, a bit of loss. You know, that's about 6 to 7 out of 10. You're going to have a couple that are big outperformers and a couple that are big underperformers. These are the statistics behind it. Now, what a trading system will do for you is basically increase this side while decreasing this side. And in statistics, we call that your basically your mean reversion scenario where you create a fat tail on one side and a skinnier tail on the other. So if we do it properly, what ends up happening is we're going to have more profits. Let me see if I can get my drawing tool here. Well, maybe I can't pull up that drawing tool that I usually like to use, but that's fine. Anyway, we're going to end up with more profits on this side, bigger returns, and fewer losses on this side if we have a good system in place. And your job is to eliminate this downside risk. Your job is to, when you have an underperformer, and it'll happen 1 or 2 times out of 10, keep that loss small and contained. The one thing that I've seen in trading is that it's not that people can't pick a good trade, and in fact, it could even be argued that, you know, technical analysis, entry points, there's not a huge science to it. You know, you can get better at it. You can certainly improve your numbers through entry points. But spending your time on entry signals, it's funny because whenever somebody starts in trading, they spend most all of their time focused on, well, when do I get in? When do I get in? What are my magic indicators telling me when do I get in? And what you find is there's a normal evolutionary process where people stop focusing on entry and then they start worrying about risk and money management, and they worry about the exit, and they start worrying about those things that, like I said, arguably are far more important than your entry point. If you can cut those losses, manage your risk appropriately, and get some big outsized gainers, you make money. It's in the statistics. Here's a study that was done by FXCM. Now, this was for FX traders, but whether you're trading currencies, stocks, bonds, options, it doesn't matter. The same principles apply. So FXCM analyzed over 43 million trades from the second quarter of 2014 through to the first quarter of 2015. Did you know that the vast majority of accounts were not profitable during that time? So in other words, of those accounts, most lost money. However, traders were right more than 50% of the time. So how did most traders end up losing money? Think about that. They had a high success rate, yet they were losing some money. The answer is that most traders allowed their losses to become big. They lost more money on their losing trades than they made on their winning trades. There was a study done on the stock and option side. I remember from my brokerage days. So in the mid-2000s, I worked as a Series 7 licensed general securities representative. I became a Series 4 options principal, and I was with a New York-based firm and was in charge of their option trading. And there was a study that came out that was eye-opening, because this is something that I had seen in play, but I'd never seen the stats behind it. And it was the exact same thing. They went through these accounts, and they said, who makes money and who doesn't? And you know what they found was this same principle, but shed in a little bit different light. Here's what they ended up finding. That the average hold time for a profitable trader, they held their profits longer, and they had their losing trades for a shorter time period. Meaning, they basically quantified it this way. If the traders that lost money maybe held their losing trades for 30 days, and their winning trades only for 15 days, let's say. And they would lose money. Why? Because they held their losers for longer periods. In other words, they allowed their losers to grow for longer time frames. The same principle, they looked at all of the profitable traders, and guess what they found? It was basically reversed. They held their profitable trades for, let's say, 30 days. I don't remember the exact numbers. They had their losing trades for about 15. All they did was one tweak where they said, you know what, I'm going to let my flowers bloom and I'm going to get rid of my weeds. Now, how many of you would walk out your front door with scissors and go and cut all of your flowers and then just let the weeds grow and grow and grow? Well, all of you say, well, that's ridiculous. Of course I'd never do that. So why is it with trades, it's so tempting to cut any winner? As soon as that flower starts to bloom a little bit, well, let's cut it down. As soon as a loss starts to mount, what do? You hope that the weed will go away on its own, right? You don't get the weed out of there. People say, well, let's just hold on. Let's hope for better days. Let's hope that things recover, et cetera, et cetera. It's just not good strategy. It doesn't make sense. So this study, I think, is very eye-opening. Here were the statistics behind it. Traders were profitable on 61% of all euro trades. Looking at the euro USD, traders won on average 48 pips and lost on average 83 pips. Okay? They held their losses about a little less than twice what they held their winners. They were taking small gains and big losses. So they made money 61% of the time, but you're not going to make money if you're 61. If 6 times out of 10 you take a small gain, and 4 times out of 10 you take a big loss. Think about the statistics behind it. Let's just say it's $1,000. Okay, if I risk $2,000 to make $1,000, I've got a problem, unless my probability is sky high. Because if I'm right 6 times out of 10 and I make $1,000 each time, I have 6,000 in gains. But I lose 4 times out of 10 and each of my losses is $2,000, I have 8,000 in losses. 6,000 in gains and 8,000 in losses, guess what? I net out 2,000 in losses over 10 trades. You see what they've done there? Their risk to reward is backwards. And as such, even with a 61% success rate, they couldn't make money. This is why we talk about risk and money management, why it's so critical. And this study shows that. What can we learn from this study? That even amateur traders are pretty good at entry points. It's not your entry point that's the problem, people. It's that we make bad decisions at exit points, at controlling our emotions. The game of trading is won and lost in position management. It is not won and lost at the entry point. That's the reality. And the data has always suggested as much. So how do we win? We develop trading systems that limit risk, maximize reward, and remove our emotions. We look at top-down analysis. We look at basket trades and charting skills, position management, maximizing gains, cutting losses. We position size appropriately, where we're not risking a ton on one trade and a tiny bit on another. We create normalized risk, where each position works similar to the other, so that we're not playing our favorites, so that one trade doesn't become critical to us and we never mess that up. Option strategies with positive risk and return ratios. Basically, the system is we have a trading plan. We have a good, solid trading plan we put together with these principles, and then, as the saying goes, plan your trade, then trade your plan. Plan your trade out well, and then follow that plan. Let's get into our criteria today. We're going to start with candlesticks. So, let's begin with candlestick trading. You've probably heard of candlesticks before. Candlesticks are another way to analyze price action, and what we love about it is it's quick and it's easy to identify what's happening. So let's take this chart, for example. You'll notice when you pull up a chart, and it's a candlestick, you'll have what we call bodies and shadows. Shadows are oftentimes called wicks. Same name, same thing, different name, right? So a candlestick shadow show, the extreme prices achieved within a period of time. In other words, the real change. So the distance between open and close. You open in the stock market at 9:30 a.m. Eastern Time, and you close at 4 o'clock p.m. Eastern Time. That window is where the price is moving, but the candlestick will show you an open and a close. So the body of the candlestick is that change. Now the shadows are your extremes. At some point in the day, you traded to an extreme high or an extreme low, and that's what the shadows show. They are not a closed profit or loss. They were an intraday move. The body of the candlestick is the actual change from open to close. Okay? So as you look at this, you will have an up candle, or what we call a bullish candlestick. When you hear the name bullish candlestick, that simply means that buyers were more aggressive than sellers. And you can see it in the price action. What the candlestick shows is that the lower body is the opening price. Anytime you open lower and close higher, the candlestick will end up with a bullish body. That's the difference in price. So maybe this stock opened at $22 per share and closed at $23. That's the change in price from open to close. The wicks would show the price extremes that were unsustained. So maybe at some point you traded down 20 cents, right? So if the opening price was 22, maybe early in the day you traded down to 21.80. Okay? It dipped a little bit, and then within the first 30 minutes maybe you rebounded back up. Now you're back to your opening price. Then you went to 22.25, 22.50, 22.75, 23. You traded all the way up to 23.25, but did it hold there? No, there was a little profit taking before the close, and we settled back at 23. So this shows that from the open to the close, the buyers were the more aggressive party, right? They were the ones that were most aggressive in getting price action, or entering into the markets, in other words, right? They were the ones that were building positions.
We're going to use charts as traders, and that's what we're going to do.
Now a down candle. This is also what we refer to as a bearish candlestick. The difference in the body is we open at the higher level and close at the lower level. So in a bearish candlestick, selling pressure or supply has been hitting the market. So think of it as an auction system. When a product is under heavy demand, there's a lot of buyers all bidding for the asset, right? If you're in an auction and there's a lot of sellers and not a lot of buyers, so imagine it in reverse, everyone's trying to sell and competing and basically trying to sell at lower and lower prices. Now there's buyers there, but the buyers are kind of stepping away, and they're saying, hey, these sellers are competing. They're pushing the price down. Yeah, maybe we'll buy, but we'll pick it up. All right, so narrow, so the asset, right? If you're in an auction and we closed at 53, that was the real change from open to close everywhere. Well, then it's, and we closed at 53 action. So sometimes these candlesticks will be larger than normal. An expanded range candlestick speaks to the fact that this was a bigger price move than normally occurs in the asset. So as we look at the price action, we can kind of look at it and say, you know what? In terms of price, this candlestick clearly stands out as being a larger move than the normal candlesticks that we can see on the chart. Now, what if the stock just has big candles everywhere? Well, then it's not considered expanded range because that's what's normal for that stock. To be expanded range means it's abnormal. It's very large in size. Usually, these are strong continuation candlesticks, meaning that when you see a bullish expanded range candle, they're very likely to be continued buying in the near future. So on a bullish move, a big expanded range bullish candle, you're probably going to see some continued buying in the near future. Now, as we look at, all right, so narrow range candle would fit kind of like the expanded range candle in that it will be smaller in size than normal. So when you're doing a comparison, you say, well, this is clearly larger than normal, and this is clearly smaller than normal. We're just looking in the neighborhood. How does this stock usually trade? We see the narrow range candle, and what does it signify? Well, indecision. You know, a narrow range candle will often be a little doji or maybe a Harami candlestick pattern. We'll get to what those mean here in a second, but you know, often small and showing some indecision. This shows that the crowd had very little movement during this time, not a lot of, pressure, not a lot of momentum, just an indecisive state. And it resolves once this breaks in either direction. So we're going to get into candlestick reversals. And when you think about this idea behind using candlesticks and analyzing price action, what we're trying to figure out is who is the more aggressive party and where is this asset going? It comes back to supply and demand. As I stack more weight on one side or the other, it's going to change the balance. Pivot points and candlesticks are a direct relationship between selling and buying, right? As long as there's more buyers, then you're piling up on one side and it's natural. That means that the stock is going to go up. As long as the buyers are greater than the quantity of shares that want to be sold. As soon as that reverses and more shares want to be sold than bought, now you get the reversal. The balance turns. Now sellers are in control, and you start to see downward price action. So as we look at candlesticks, you'll often notice that there are long shadowed candles. Long shadows indicate that there was a failure on the part of buyers or sellers to hold on to gains or losses. A long lower shadow like this is normally a bullish indication. Basically, and especially when it follows a sell-off. So if it follows a sell-off, this is one of the most powerful signals that you can find. It's one of my two favorites. I love long shadowed candles. I love expanded range, what we call the engulfing formation. Those are my two favorites. And basically, this indicates that buyers, well, think about what was happening. If the price has been falling for the prior few days, on this particular day, it sold off violently, but buyers came in more selling pressure, a likely bearish move to follow, right? So you always want to look at candlesticks within context. Context is very important. If it follows a rally, then it's more likely that indecision is bearish. If it follows a sell-off, then it's more likely that it's bullish. As I said, hammers and shooting stars, These are my favorite long shadowed candles. To be a hammer, you typically have a small body and a long lower shadow that's about 3 times the size of the body up here. So let's say that the body is 50 cents between the high and the low. How long should this shadow be? Probably about a buck 50 or more. The shadow should be around 3 times the size of the body. And if this follows a multi-day sell-off, it is very bullish for the future. A shooting star, very similar but flipped around. Follows a rally. The shooting star should have a small body and a shadow that is 3 times the size or more. When it follows a multi-day rally like this, it points to a bearish future. As we said, buyers step in typically, and in fact, let me put it this way. Most major stock market reversals in high volatility environments form a hammer at the lows. Guess what? We just had a big market sell-off, did we not? Remember 2 Fridays ago? What did the market candlestick form? Well, look at the SPY. Look at the SPX. You'll notice that on that Friday, at the absolute lows, there was a huge reversal off of the lows. In fact, the S&P reversed 3% off of the lows, and it left a long lower shadow just like this one, and we've zipped to the upside another 5% or whatever it's been since. Do these candlesticks give you information that cannot be obtained any other way? Absolutely. So watch for those hammers. There is no candlestick more likely to occur at a market bottom in a high volatility environment than a hammer. It is the most likely candlestick in that scenario. My other favorite candlestick formation is engulfing. To me, the engulfing formation is a big smack in the face to whoever had previous control. So a bullish engulfing forms when the bullish candle completely engulfs or swallows the prior bearish body. So the bears had control. The selling pressure yesterday, though, is completely reversed by the fact that we just swallowed it up. We engulfed it. And so this body from the prior day's bearish candle is engulfed by today's bullishness. Very powerful reversal, more upside is expected. In addition, you'll see the bearish engulfing. That's the reverse side. So yesterday's bullishness is completely engulfed. Side day is where the bullish body fits inside of yesterday's bearish body. So pregnant or body within, the bulls are that's kind of a weird way of saying it. I'm not going to say that. But anyway, the bulls are now somewhat trying to take control, but it is a quieter reversal. Inside reversals are not as powerful as outside reversals, right? And engulfing is a complete outside reversal. Inside reversals are a little quieter. The bearish Arami, of course, bearish body fits inside of the prior candle's bullish body. So pregnant or body within, now we have this bearish candle that fits inside the prior day's bullish body, and we're more likely to fall than to rise going forward. Great candlestick formation. Now, at a glance, candlesticks tell you really important information. You can pull up a chart. Instantly, you can see just in today's price action, are we moving up or down? Is it a bullish candle or a bearish candle? What's the volatility like? Well, is it narrow range, meaning it's smaller than normal?
In the Market Master course, we want you to build a solid foundation to work from.
Reversals, they're considered to be most powerful when they're engulfing outside reversals or long shadows. The more powerful the candlestick reversal, a lot of times the more powerful the follow-through is in the price action in the days and weeks ahead. So we've now covered candlesticks. We're going to go into support and resistance. As we get into support and resistance, when you think about this, we're going to talk a lot about floors and ceilings. But you got to be a little bit careful with support and resistance, because it's really easy to think that, well, this area should be support, this one should be resistance. Just because you think something should occur doesn't mean that the market really cares what you think should happen. What matters is, where are we at? Are we really building a floor or a ceiling? So support is only something you've identified it, but it's only support if it actually starts to work. So we use candlesticks and these levels in combination, meaning if the price comes down and then it stabilizes on the level we expected to act as support, well, great. You see buyers returning. That means we're more likely to actually see this act as support. So I always caution that I don't really necessarily buy aggressively as we're falling violently down to what I think will be support. Instead, for me, it's about waiting for stabilization. You could take it one step further and say, you know what, I'm not going to trigger in until it actually starts to pivot upward. And we'll teach that, where you could trigger in if it moves above the prior candle's high. That way you're getting follow through. I don't always wait for that confirmation, but some confirmation is critical. I at least want to see a bullish candle. Whether I try to buy in on the day it's creating a bullish candle, the next day, whether I wait for it to pivot higher, that can vary from trade to trade. I do try to keep it systematic and the same, meaning that with certain strategies, I use a certain method. With other strategies, I use another method. We'll talk about those as we go. But I just want to emphasize that support and resistance is expected to work. We do need to see some price action actually follow through. So support is a floor, resistance is a ceiling. When you look at price action, here's where we're expected to find stabilization, right? We walk along the floor. We go up the stairs to get to the next level. Essentially, you've gone to a higher zone. So think about this in terms of price action. What you'll typically find is that as prices move up and go through a prior ceiling, what do you think happens when the price comes back down? Well, it actually uses that as the new floor, right? And it stair steps its way to the upside. Prior ceiling, new floor, and so on. Just like this. What is a ceiling, if you're standing down here, is actually the floor if you're standing up here. Now you look up and you say, well, there's the ceiling up there. Okay? The stock breaks through, and guess what? What you're now looking down at as a floor, from the lower level, it looks like a ceiling. What's our point? Support and resistance is interchangeable. Old support is new resistance and vice versa. Right? These are levels that we think have substance and significance. Traders call it memory. Now, if you think about the logic behind it, here is a quick and dirty example, just quick and simple as far as how it works. Let's say XYZ stock is trading in this range. Okay, half the year it's trading in this range. In fact, this isn't entirely unlike our S&P 500. For the first half of the year, complete sideways range. Think about all of the shares that are bought in this area. Now, there are shares sold as well, but just think of all the people buying shares, whatever. Okay? Imagine the prices fall. As they fall to the downside, sure, some of the people that bought up here are selling, but not all of them. Here's why prices have memory. These were buy points for people. These were areas where they expected one thing, and then they got another. And so what ends up happening is all of this creates what we call overhead supply. When you have a lot of shares that were bought at higher prices, it's very hard for a stock to advance. Because as it attempts to advance, what's the problem? You have all of these people that want to be made whole. They want to dump their position, they're losing money, they're unhappy, they're, et cetera, but they're waiting for a rally. So as you come up, they say, you know what, we're back towards the levels we bought, we want to get out, we're break even, whatever. People hold the break even all the time. It's crazy. But anyway, it works because all of these people that were buyers, they're now acting as sellers, and that stock gets resisted and pushed back down. And the same thing works in reverse, of course, on the upside. So, as we look at support and resistance, it's a price where selling momentum becomes exhausted and buyers step in because they find value. It's expected to hold, but it really confirms once you start to see bullish indications. So we like to see a bullish candlestick, like this engulfing candle you can see down here at the bottom. I'll circle down here. See how that bullish body engulfed, it swallowed it up. And then down here you see a long lower shadow and then big expanded range engulfing. We can see that support is holding. Why? Because we're getting candlestick confirmation. That candlestick confirmation is buyers returning, period. The only way this turns into a bullish engulfing candlestick pattern is if there's real buyers. Now, of course, that doesn't guarantee success, but it certainly improves your probability of doing well trading on this support level. Key concept: support is not established until prices actually go up. The upward movement in price, driven by current demand, is what defines and establishes the new pivot support. All other forms or expressions of support are just theoretical. This should act as support. This should do something, but it's only confirmed, it's only actually support once it starts to turn up from a certain area. Old support and resistance form new levels of support and resistance. Think of floors and ceilings. Once you move up through a certain area, it now becomes, what was your resistance now becomes your support. Or what was your ceiling now becomes your floor, and vice versa. Okay? Now, resistance. This is a price where, as the name suggests, buyers bid the stock up and then sellers resisted it at those levels. Well, we think it's going to be resistance, but of course, we should see bearish candlesticks. We should see sellers coming back in. We should see high, long wick shadows like these. What do those point out? They point out that bidders pushed it up and sellers pushed it right back down. And basically, it fell right back in their laps. Sellers are attracted by those higher prices and push it all the way back down. It failed. It was expected to hold at resistance. Now we have confirmation that it is actually positively being resisted as we speak. So always want that confirmation. Resistance is not established until prices actually start to go down. It's the downward reversal that actually creates and confirms that we have a resistance zone. And as we said before, old support now becomes new resistance in downward trends. Resistance becoming support, that floor and ceiling concept. When one level fails, a new level, the new area kind of controls this. So I'm always thinking, in terms of different examples of how this is applicable. And my daughter and I, just the other day, were watching a television show. She's convinced that she's going to become a veterinarian when she gets older, and she loves animals, and specifically not cats, but the cat group of lions, tigers, cheetahs, etc., etc. So anyway, we're watching this, and these lions have their territory, right? And they fight for it. And on occasion, this male lion will come in and battle it out with the other, and if he wins, well, that territory now belongs to him. And so you can kind of think of it in that term, at least this is my way of thinking of it, that these zones belong to someone, right? Resistance belongs to sellers. Sellers control this area, but they only control it as long as they're willing and able to win the battle. if the new lion comes in, or in other words, buyers overwhelm them at that area and push to new highs, they no longer control that zone. That zone now belongs to someone else, right? This is new territory. And that's how these basically are interchangeable in that this is where a lot of selling pressure kicked in before, but not anymore. This is now where buyers are going to look to step in. They're going to look at this and they're going to say, you know what? We have a situation where before prices failed here, but now it's zipped up through that. Hey, I don't have as many shares as I want. I'm going to buy at the prior breakout zone. I'm going to, if you're caught short, you say, wow, resistance didn't hold, and I'm losing money. Okay, if I get a pullback back to that old resistance, that new support, I'm going to buy back my shorts. In other words, there's a lot of reasons to buy and not a lot of reasons to sell as you come back to that zone. Old ceiling, new floor, new territory. They're interchangeable that way. Same thing is true on support side. When support levels break, who does it now belong to? It belongs to resistance. So this was where buyers came in before. Now it's where sellers are likely to reemerge. And if we get candlestick confirmation at those levels, you pounce on it. Great trading setups, and we'll come back to that. Whole round numbers play out often, and this is especially true at the significant whole round number points. So $50 per share, 60, 70, those are more significant than if a stock goes to $27.53. Okay? How many people really care that it's trading at $27.53? Well, not nearly as many as
in the Market Master course. We want you to build a solid foundation to work from.
I'm always reminded
anything you do, you're going to build a home.
Times,
you've got to have
I remember when the Dow, and this was years
you,
ago, but when the Dow first went to 10,000 points, maybe some of you traded back then. Well, as it tried to get through 10,000, it failed, and it just couldn't get there. Couldn't get there. And every time it came up, what was happening?
You're going to build a home.
Basically, sellers. You came to this big whole round number, everyone was taking profits.
Other than option
because they were saying, we've touched 10,000. This was our price target. This was this. Whatever the reason is, people don't set a lot of price targets at Dow 9,563. They say the Dow's going to 10,000. So once you get up to that area, everyone would sell and then fall back down. And then later on, a couple of months later, it'd reemerge and it'd try to get up to it and it'd fail again. And it was a psychological resistance. We just couldn't push through. Well, the Dow finally broke through. How did it break through? The buyers overwhelmed the sellers. They pulled out the party hats and they, down on the floor of the New York Stock Exchange, they were blowing the whistles and things like that. Anyway, fast forward to today, and we're well above 10,000. But it was a psychological zone. There was nothing magic about 10,000 other than that market participants were watching and reacting to it. Same thing happens in commodities and other markets, right? If the US dollar, if the Euro USD trades to parity to 1.0000, that'll be a huge support level because it's such a psychological zone. When oil prices first traded to 100 a barrel, maybe you remember that they traded up to 100 and then they fell back violently. And then later on, they went through 100, and guess what? Oil spiked all the way to 147 because resistance was broken. When gold first traded to $1,000 an ounce, guess what happened? It failed, and it fell back miserably. Fell all the way back in the 780 or something like that an ounce. When gold reemerged and went back to 1,000 again, guess what happened? We broke through 1,000 and gold zoomed at 1,800 an ounce and so on. These these big whole round numbers are where orders tend to accumulate. They tend to fail initially and then create big breakouts down the road. So we've now covered support and resistance. Let's now combine some factors together. Pivot points with candlesticks. As we talk about pivot points with candlesticks, I want to emphasize a couple of things. Pivot point first of all, what does that mean? Well, we'll talk about it. It's a change of direction. I actually played basketball this morning. I play basketball early mornings, Tuesdays and Thursdays, and I've been up since, 3 or 4 a.m. my time. But anyway, I play basketball, and a pivot point is a normal move in basketball, right? You're playing ball, and you keep one foot in the same spot, you turn to another direction, and you can pivot around that foot to change directions, find somebody to pass to, or what have you. The same thing happens in price action. A pivot point is the turning point. It's where sellers, the selling pressure turned into buying pressure. And so what it creates are these markings on a chart, peaks and valleys. And then you can compare peaks and valleys to one another. And you can quickly identify that if, hey, the pivots are going up, we're in an uptrend. You can compare the peaks and the valleys, and you know what? The pivots are going down, we're in a downtrend. That's pretty cool. Ed says that he still has his Dow 10,000 hat from working on the Philadelphia Exchange back in the day. So Ed knows exactly what I'm talking about. They pulled out the hats and the whistles and things and had a little shindig when the Dow broke through 10,000. Well, what did it ultimately do? It pivoted and broke and took off through prior pivot highs, through the 10,000 level, and accelerated from there, right? So let's put this price action and these pivots together. When a stock changes direction, it forms what we call a pivot. A pivot point is either the highest candle in the rally or the lowest candle in the sell-off. Now, I like to simplify this. You can go crazy because you can say, well, every time it turns, you have a pivot. So you go up for one candle, you turn down for one, you go up for one, you turn down for two. You can go crazy and you can start saying, well, this is a pivot, that's a pivot, this is a pivot, that's a pivot. What I like to do is simplify. When I'm really looking at peaks and valleys, I'm going to take all of that kind of choppiness and just do what I call dot to dot. So don't worry about a small pivot, meaning, what if you turn down for all of one day and then you go right back up? Then I ignore that little bump and I would just say, well, this is still the upward trajectory. A true pivot should have some follow through to it. Now, once you get the follow through, now you have a real peak, right? So if you were looking up a mountain range, each one of the more significant peaks have a name, right? So this is such and such peak, and then this higher one is, such and such peak. And eventually you get to the very top of the mountain, which is the most significant peak of all. And the same thing happens at lows, right? You can go to the Grand Canyon, I'm sure, this is such and such a plateau or whatnot, and this one is such and such a canyon, and this one is the lowest point of the Grand Canyon. It's the most significant and has some special name to it. So what we're pointing out is that not all pivots are created equal. They're minor, but you will get some majors, meaning most of the pivots are kind of small and they just work within the trend. It's if it's a trend-changing pivot that it's upgraded, that it becomes a mountaintop or a canyon low, that it has more substance behind it. So let's think about that process as we go through these. A pivot high is also known as a swing high, and it simply forms when stock has been trading up. Well, how does a stock trade up? Buyers, right? Buying pressure pushes it up, and then it starts to fall. What's causing it to fall? Sellers. Very simple, right? So pivot highs look like a peak on the chart. Initially,
and you had a little bit of demand
now,
back
these
in
three candles, it takes 3 candlesticks to form a pivot. So far, we've only pivoted down.
If you think that you can come into the market
that's
and
hardly
just
the end of the world
kind of
for this
feel
stock. But it could evolve into something worse. 3 candles create a pivot high. There must be a lower candle on the lower left and on the lower right, and then you have a pivot high. So what do pivot highs look like? Well, there are some that are more significant and some that are less significant. you can draw a circle, and we just highlighted some of them, right? Here's a pivot high. Here's one. Here's one. We didn't circle all of them, but we just wanted to kind of show some of the pivot highs. Here's what I would do personally. If I were looking at this chart, I'm going to try to, see the forest from the trees and so on and so forth. What I'm going to do is I'm going to do my dot to dot. And if I were to just drag a line across this and measure up the price action, to me, I'm almost going to ignore a lot of this. And to me, that's the movement of the stock. So here's every one of the pivots. If I really do the dot to dot and don't make too much of a big deal out of some of what was happening at various spots. You see all the lows? And to me, these are your mountain ranges, right? Ignore the smaller ones that are going up, and then 3 or 4 days later, you make a new high. Why is this one not significant? Because we were right above it a short time later. Why is that one not significant? Because we were above it a short time later. That's the top. And then you sell back off. There's the next peak. And so as you start to use these, guess what you find? If you measure your pivots correctly, you'll see the trend lines. This stock has a nice channel that it's in. Now do you see the channel formation that this was in? Now if you try to make something out of every single thing that's happening in this chart, you'll drive yourself crazy. Every day is not significant, but this day, where it had a huge hammer, is significant. This day, where it formed a big bearish reversal and had a huge expanded range bearish candle, is significant, and so forth. So you're seeing the big picture, you're seeing what really matters, and you're just wiping out all of the noise, okay? These are your pivot highs, these bigger mountaintops. Don't worry too much about the smaller guys, the less significant things that are kind of happening in between. Swing lows or pivot lows happen when the stock has been selling off, that's selling pressure, and then buyers step in and they start to bid the stock back up. Pivot lows look like a valley. Are all valleys created equal? No. Some of them more significant than others. 3 candles create a pivot low, but we really want to focus our attention on the ones with substance, right? So as we look down the Grand Canyon, here's a big plateau, here's a big plateau, here's a big, plateau. So these valleys that have a real V shape to them. And again, I think it's most easy if you do the dot to dot process, which will create, if you dot to dot it, you're either going to see the mountain range or you're going to see the canyons, right? You're going to drag your line across. And if it's going like this, well, then you have a sideways movement. And that's fine. We'll talk about those later on. We'll actually teach sideways trading. So here's pivot lows. Can we go crazy? We didn't mark all of them, but we kind of focused on the right-hand side. Are all of these pivot lows? Yeah, realistically, and there's a lot more, right? Any candle, any 3-candle formation that goes like that is a pivot low because it has that little dip to it. But that doesn't mean it's really significant. So, as I said before, we do our dot-to-dot process. Then here's really what's happening. I didn't draw that perfectly, but you get the point. That's what's truly happening. These are your pivot lows that matter, right? And ignore everything kind of in between. That's your support level. That's the upward trend, the rate of advance, as we call it. And is this stock in an uptrend? Yeah, I would call it not. I mean, this is a robust uptrend. This is when it was really breaking out. This I would call a steady trend. This I would call a more neutral to bullish market move because there's a lot of back and forth. There's certainly deep pullbacks, but it's still just kind of making its way to the upside, right? The pivot lows overall are going higher and higher. So, bulls versus bears. Remember this battle that takes place. A pivot, a change in direction is a direct result from either buyers losing out to the sellers or vice versa. So pivots show us the trend. They show us who has control, where the battlegrounds are, and who's taking control of it. So as we look in an uptrend, again, we didn't want to focus on every little pivot point. We said, let's just really figure out what's happening here. Well, the price action is moving to the upside. So we can still see that we can have an upward push, higher highs and higher lows, and buying pressure in the asset. This is an example of an uptrending stock. As it says, bulls are winning the battle overall. Right? Now, what about a downtrend? In a downtrend, your pivot formation will be moving from upper left to lower right. So, bears are winning the battle. Overall, the bears are in control. That doesn't mean that every day is a down day. It means that overall, the general trajectory of the trend, the stock, is moving on a downward pace. I remember that I pulled up a chart. I may have already told this story, but I have a 7-year-old daughter, and I pulled up a chart, and I've never taught her trends or anything, but it was a sharp downtrend, and she said, "Ooh, that looks really bad." And so instinctively, she knew that price action falling, that wasn't a good thing. And so if we really simplify it down, most people think prices falling is a good thing. Well, it's not it's very good for bearish trading, but it's not good for buying, because lower prices, as I like to say, selling begets more selling. Selling creates more selling because as prices fall, there's more people that panic, that want to sell. There's brokerages that will force liquidate people, and close positions because they have too much risk. They're losing too much money, etc. This happens everywhere, in every financial institution out there. So, the point is, selling begets more selling, buying begets more buying. These trends are powerful, and they typically have quite a lot of follow-through. So, bullish candlestick patterns, we've talked about quite a few today. Let me mention the ones that we didn't. I didn't spend a lot of time on the Dragonfly Doji, but I mentioned it. A doji is any time that the open and close basically ends up at the same level. So here's your classic doji where it's just kind of that plus sign. Here's a dragonfly where it's a long lower shadow candle. The Dragonfly Doji, to me, is the same as a hammer. Same outlook, same expectations, pretty much the same style of trade. We also didn't really cover the piercing line in depth. It is a bullish reversal. It's not a harami because it doesn't fit inside of the prior day's bearish body. It's not an engulfing because it doesn't engulf or completely swallow up the prior day's bearish body either. But it closes above the midpoint. So as it closes above the midpoint, that's called a piercing line. It's a bullish reversal overall. And notice that all of your bearish candlestick reversal patterns follow and advance. You rally up. In conclusion, as we get into this conclusion, we want to give a little homework. We want to do a couple of different things in today's class. So, first, supplemental videos. I referenced them a couple of times. We offer supplemental learning videos that cover specific topics discussed in each session. So if you want to dive into a singular topic, breaking it down in greater detail, like candlesticks, for example, we show more information. It's in your supplemental videos. Make it a habit to periodically check through these areas since we're constantly adding more content. In fact, a couple of months ago, I added that Bollinger Band system that I use. That these are just examples of the supplemental videos that I've brought up today. Next, in conclusion, candlestick patterns can give us insight into supply and demand levels for a specific time period. Pivot points are areas of bullish and bearish transition that can indicate directional change. So where buyers are regaining control or sellers are taking control. Important resistance levels are associated with price. They can be used in determining levels of entry and exit when taking trades. But remember, they're expected to act as support and resistance. They're confirmed when it actually is starting to be supported or resisted through the candlesticks. Now your homework assignment. A couple of things we'd like for you to do that I think will be very good for your trading. And then we do have some tests, of course. that always come later on as well. That you'll be tested on your knowledge of the various products and systems and different things that we're going through. So we'll test you on, what an engulfing candle is or these types of things. So first, pull up some candlestick charts and apply what you learned. Start with a 6-month daily chart. Just work your way forward. See if you can identify long lower shadow candles. Go and see if they happen at a lot of the low points, at the pivot lows, at the key turning points. See if you can find some bearish engulfing up at the highs, things like that. See if you can identify these in the chart, and then think about where they are at in context of support and resistance, and also think about where they're working within the trend. So I'll give you an example. Here's a trade that would be more actionable. We pull up a chart, and it's moving from upper left to lower right overall. So the pivots are declining. As we see that, we say, okay, we have a more bearish chart. We can see the prior pivot low, and we know that what was support may well act as resistance. We get a price move to the upside, and when we get to that resistance zone, we form a shooting star candle, long upper shadow candlestick. That's what I mean by context. We have a downward trend working in our favor. We have resistance, and we have a pivot, a bearish candlestick
and this should be
pattern
something that should
pointing to a pivot likely
say you roughly break
at the resistance zones. Look for these pivot points and formations of support and resistance levels, and work on using them together, putting the pieces together so that you have more actionable trades and better probability of success. Okay? Now, with that, next week we are going to dive into, as I promised earlier, secondary indicators. So this is where we're going to get into ATR, MACD, the indicators that take price action, put them in calculations, kind of twist and turn those numbers, and then give you a different way of reading it. As I like to say, primary indicators are absolutely what's happening, but sometimes secondary indicators can shed some light on something that you can't see naturally. Maybe something that's not visually you're able to see with the naked eye. So if I'm walking on the beach, I might not be able to see some coins or something underneath my. If I have a metal detector, a secondary indicator, something that can kind of alert me to something, well, it might be useful in that circumstance. So, that's kind of an example of how we would use secondary indicators as confirmation, and we'll cover that topic next week. So we'll be back next week, same time, same place. Hope you've enjoyed it. We'll see you all next time. Goodbye, everyone.